Good morning, good afternoon, good evening. My name's Dipesh Patel, editor at Trade Finance Global and host of Trade Finance Talks. Welcome to our listeners and thank you for joining us from all around the world. Today we're live streaming a very special tradecast, broadcasting on LinkedIn, Facebook, YouTube and TFG's platform. Today, we're talking about CPRI or non-payment insurance, performance-based or surety, and export credit insurance. And yes, I'm about to tell you why there's an umbrella in the background. The media often shirk trade credit insurance as an umbrella that doesn't open when it rains. But to what extent is this actually true, and how has the product fared during recent times? In a world where roughly 15% of trade is protected by credit insurance, which really does help increase lending capacity, provide regulatory capital risk, manage concentration risk and country limits, eyes are often on the trade credit insurance stage. Managing commercial and geopolitical risk in trade transactions has been paramount recently. We've seen the pandemic shut shop on businesses around the world, the humanitarian and economic ripples of the Russia-Ukraine war, and mounting inflationary pressures. Trade Finance Global are hosting this tradecast today, kindly sponsored by Tinubu, to delve deeper into the realities of today's climate. Therefore, I'd like to welcome to the stage Gary Lowe, Global Head of the Global Credit Insurance Group at Standard Chartered, Jérôme Pezé, CEO at Tinubu, Janusz Władyczak, CEO at KUKE, the Polish ECA, and Richard Wolff, Executive Director at ICISA. Welcome to this tradecast. So, introductions. In no more than 30 seconds or so, I'd like you to all give a quick elevator pitch. Who are you? Where are you from? And what do you do? Gary, I'll start with you.
Great to be here, Dipesh. My name is Gary Lowe. I'm the MD and Global Head of the Global Credit Insurance Group at Standard Chartered Bank, which means that my team and I are responsible for all of the non-payment insurance and some political risk insurance that we purchase across the bank. And we use that to manage exposures, capital and returns.
Thank you very much. Jérôme, over to you.
Yes, good morning. So after decades of being an underwriter and working in trade finance, I co-founded 21 years ago Tinubu Square, which is a leading company providing a solution to digitalize credit insurers and surety players.
Thank you very much. Janusz, over to you.
Good morning, everyone. My name is Janusz Władyczak. I'm a CEO of a Polish credit agency. So trying to support Polish exporters all around the world and trying to be involved in many projects which are happening at the moment and trying to develop the ECA business altogether with other market players.
Thank you very much. And Richard, last but not least, over to you.
Good day. Dipesh, thanks for having me. It's lovely to be here. I'm Richard Wolff. I head up the International Credit Insurance and Surety Association, and it is what it says on the tin. We are an association of largely private trade credit insurers, surety, and their reinsurers. We advocate for our members, and we try to spread best practice.
Thank you very much. What an excellent panel we have here from all around the world, from Poland, France, Holland, Singapore, and London. Let's start with a bit of a helicopter view of trade credit insurance, and just to break it down to our listeners, Gary, perhaps can you give us a short overview and synopsis of what trade credit insurance actually is and what it encompasses, perhaps talking about the difference between public and private, short-term, long-term, and how it really underpins global trade?
Well, I mean, there are multiple parts to this industry, and the piece that I specifically focus on is around non-payment insurance, which is a tool to protect lenders, but also traders and corporates against non-payment of a debt by a borrower or by a buyer or an obligor. And therefore it sits within our overall distribution strategy. I sit in a platform within the bank which looks to optimize capital, manage risk, enhance returns, but perhaps most importantly of all, support our clients by doing more. So like any prudent lender, we have overall risk appetite on a particular obligor, group, sector, country. And we do business that we like doing, but in order to do more of it, that there need to be tools to manage that overall risk, and that's where we use the product. We use it in multiple billions per year. We have multiple billions exposed at any point in time, and it's, as I say, it's an important part of our overall syndication and distribution strategy. But if you look at the different strands of it, so my piece is around this kind of medium-term non-payment insurance. The terminology is a little bit interchangeable, but that's what we call it. Some people call it CPRI or structured credit. It's the same thing. And then trade credit insurance is the original and by far the larger piece of this world, which is equally well used by banks and by corporate sellers of goods, facilitating cross-border trade across the world. Again, it might be with clients and with buyers you have a perfectly good relationship with, but need to manage overall risk exposures, or it could be getting into frontier markets and supporting credit risk in a way that really is around risk management more than only aggregations. And then of course there's the surety piece of this, which is more around performance protection. And then of course, probably the most famous, and I'm sure Janusz is going to tell us the most important part of it, the multilaterals, agencies, and public sector bodies who are really about promoting originally national interest in terms of exports, but increasingly supply of goods, flows, services, but also ESG objectives where governments have a development interest around ensuring that the trade, project finance, infrastructure development is happening in a way which is bankable, and therefore credit risk is protected. So that's the kind of world of credit insurance overall. Different strands of it attract different market participants, public and private, and attract different buyers, corporates, traders, and banks. And I think sometimes they are quite separate, but broadly speaking, we're all trying to do the right thing here, which is manage exposures, manage capital, manage returns, and facilitate global trade and investment.
Thank you very much. I'm very impressed you managed to give that overview in just under 2 minutes, talking about CPRI, non-payment trade credit insurance, surety, and the ECA side of that. And for sure we'll move to Janusz in just a second. But actually, Richard, I'd like to ask you, and also within the context of the umbrella that doesn't open according to some media outlets, why do you think that was portrayed, and also can you talk about why banks utilize trade credit insurance?
Why banks utilize trade credit insurance is very similar to what Gary just said. Speaking with our members and looking at industry research, we basically see 5 reasons why banks utilize the product. And that's first, to increase lending capacity while complying with internal credit limits. And that's what Gary said, helping clients, helping to do more. The second really important one is regulatory capital relief. If we can make the whole process just a little bit cheaper and just a little bit more smooth by saving capital of the clients of our members, the financial institutions, I think we've done a pretty good job, and that's why clients buy. You can also think of concentration risk management to specific industries, to specific events, for instance. And something Gary mentioned, increased return on capital. Yes, it is important. If our capital for a specific risk is cheaper than the one of the financial institution we serve, we've done a good job. And last but not least, country limit relief. Some financial institutions are full on countries. They turn to us and say, can you take some country risk off our hands? Now, this applies to basically all asset classes that banks place. Now, my members generally cover the risks stemming from non-payment of trade finance. So meaning receivables, meaning payment undertakings and LCs, and also supply chain finance. Now, talking about the umbrella that doesn't open, the product works. And I think the best proof of that is that the loss ratio hovers around 50%, with $346 billion in transaction facilitated for banks. Of all the claims that we've received in the time period between 2007 and 2020, 96.8% of all claims were paid. And factoring companies will easily 4 times that amount. So this umbrella opens the page.
Thank you very much. And I guess, Janusz, if the umbrella does open, and what's the purpose of an ECA in terms of providing that public support? Is it when the private market stops?
It really depends. I think nowadays we have an issue that we've for already a couple of years. We're seeing loads of turmoil going on around the world. So in fact, trying to be involved in long and medium term transactions, it is hard not to use the umbrella of ECAs or other multilateral type of institutions. If we are talking about the short-term business, then maybe it's not an issue because we can always find the solutions, especially if we are talking about trade, which will be happening in so-called developed world. Whereas we've got loads of commercial type of players on the market. Whereas if we go towards developed or developing countries, but in a slightly different tenor perspective, and what we are observing even in countries which we've in the history we perceived them as quite safe, nowadays you cannot be really sure if they're still in the same situation. With all those turmoils going on, I think all the market players, not only investors but financial institutions, all of those need someone who is going to support them. And I think ECAs are playing much more crucial role than they used to. I think the whole industry went through, especially through COVID times, it went through plenty of changes. So in fact, we're not only those who are eager to be involved in transactions in countries which are more risky, but at the same time, we've been employed during COVID times in many countries to help domestic economies, to help not only exporters, but to help companies. So in fact, our role has changed a lot. And we are not only those who are in fact, at the end of the day, supporting or helping to do the transaction, but at the same time, we try to facilitate the trade. So we are those who are playing the role of middlemen who is searching for projects with investors, with financial institutions, with banks, and together with them, then we are trying to find companies who are eager to perform those projects. And for instance, we're trying to facilitate trade on the global scale, looking for suppliers. So the role of an ECA, it's not the pure role as we had in the past.
I guess let's go into a bit of a macroeconomic overview, and especially given your such critical position as CEO of a Polish ECA. Janusz, can you give a short overview of how the economic landscape has fared and also changed since the pandemic, and how the fallout's also been compounded by the current political risks that we're seeing?
Sure, Dipesh. I think what we are currently observing, it's obviously as I mentioned before, we have a couple of issues going on. So, which means that from the macroeconomic perspective, we had a nice V-shape bouncing after COVID. So everyone was pretty excited that finally we are going we are speeding up and all, let's say, trying obviously to work a bit with the supply chains that were still under some kind of reconstruction after what happened during the COVID time. And what we suddenly experienced was the war in Ukraine, which no one, as we are sitting here, expected. And this is something which happened to all of us suddenly. So in fact, we are all affected of what is going on, because then we have three factors. We have a factor of still supply chains being affected, and it's not really universal to the whole world. We have areas which have been more affected than others, and treatment of COVID is still differs from country to country and from the region to region. And then we've got this political turmoil which is going on, and this is something which I think we all have to take into consideration when thinking about macro and what is going to happen. We've got interest rates through the conflict. We've got inflation, and then through the inflation, we've got interest rates skyrocketing. We haven't seen those numbers, those percentages for the last 30, 40 years. This is something which is a huge issue for developing countries, especially. We have a big issue with what is going on with hard currencies because they are appreciating a lot against developing currencies, which means that in fact at the end of the day affects a lot what we are doing here as we are sitting, which means that all the projects in developing countries in those regions need to be considered more risky. We need to think more about how to mitigate those risks together for different, obviously, ways. Then we have those. Then at the end we have a factor of as prices went up, and we have a shortages of food all around the world. So this is something which could cause a lot of social and at the end of the day political issues in many countries. So there is plenty of factors that will definitely implicate that macro is not going to look as we would love to when we were entering 2022 a couple of months ago.
For sure, thank you, and thanks for outlining some of those factors. And Jérôme, what's your view, given you sit within a lot of those industries and you can talk to a lot of those counterparties? How's the market fared with some of these unprecedented challenges around the pieces Janusz mentioned: inflation, war, political risk, disruption of supply chains, etc.?
Yeah. Just to add to what rightly say Janusz, I remember that in the fall of 2019, and we were together, remember it, there was a consensus within the credit insurers that there would be a potential change in risk cycle due to the fact that the valuation of companies were excessive, the Schiller-P ratio was beyond 30, the debt was beyond $225 trillion. There were a number of trade disputes. The economies were growing asynchronously, and there was discussion regarding multilateral versus bilateral views. In between came the COVID, with all the impact of the COVID, and then the war in Ukraine, and then we got the inflation. And if you add all the elements which were identified in 2019 already, which already at that time brought many private, notably credit insurers, to adjust their capacity, are still there. The debt is 320 trillion. The Schiller P ratio, by the way, which went to 38, is today, I think, 30. So which means valuation are still excessive. All those elements prevail. So, and one of them is interesting, the fact that during the COVID, the bankruptcy totally stopped with the massive flow of money in the economy. Give you a figure, the bankruptcies in Europe moved from 350,000 per year to less than 200,000. So we are going also to face the fact that there will be a catch-up effect. So we are, in a sense, to a situation, and Janusz is right, close to the one of the 73 with the oil crisis, with the cost of commodities, with the post-quantitative easing policies, with the geopolitical risks and the inflation surging, but also with that last element I mentioned. So indeed, credit insurers are today in a position where they are going to face an unprecedented level of uncertainty. But they have accumulated also unprecedented level of profit during the last 13 years with historically low level of claims. They are going very likely to be alone that time to face the crisis without massive government support. Reinsurance capacity was unlimited in the last years. It's going to be more scarce. Credit insurers, cannot repeat what happened in 2000, 2009, and in the first semester of 2020 with this umbrella model. They will have to be clever, selective. Demand will surge from corporation, from bank, as well for solvency requirements, while the cost of risk will increase. The growing role of ECA, which we saw in the last 3-4 years, will continue, which means that there will be a need for credit insurers to be capable to also collaborate differently between themselves. They will have to be more clever, and the demand, as I mentioned, will in the same time significantly increase.
Thank you very much, and yeah, serious repercussions from the states withdrawing their support to private businesses recently following what happened during the pandemic. Richard, do you echo this, and what's kind of happened from a claims and payouts perspective, but also what do you think will happen from a claims and payouts perspective as a result of recent events?
Well, first of all, if you would have asked me this question 2 years ago and to give you a prediction what the claims ratios would look like now, I would have been wildly off. So we were expecting the worst, we got the best. The claims environment has been extremely benign for the past 2 years, largely because of government support to the real economy. Now, if we look into the future, it's often said inflationary pressures, geopolitical tensions, everything to do with commodities. What I see in prospects is very uneven. So according to research done by our members, we see the global business insolvencies rebounding in 2022 by some 10%, next year by some 14%, somewhat dampened by state support, or continued state support in France and Germany. On the other side of the spectrum, we see sharp rebounds in the UK, where we do expect insolvencies to go up pretty sharply, and we're already seeing it. And in Asian countries, where you see the number of trade debt outstanding, the number of days, going up steadily and steadily. And this will cause some stress in the whole supply chain, because not only does that show that liquidity is a little bit tighter, but it's like when you dance in a long line, if the start of the line varies a little bit, the end of the line varies a lot. And that's what we're looking, that's what we're bracing ourselves for. And what Janusz has also said, country risk is not behaving as it did over the past couple of years. So if I look at my members, country risk downgrades outnumber upgrades by more than 10 to 1 at this moment. And yes, it has everything to do with the strength of the dollar. It has everything to do with commodity prices. And it will have its repercussions on the claims ratio of my members.
Thank you very much, Richard. And you know, I guess I'm picturing a dance train now with some wild people at the back. Gary, would you say risk appetite has, as a result, then has kind of moved up the credit curve? And I guess it's, you know, I'd love you to comment on the idea that, you know, the industry is supporting the best, the AAA, but I also ask, you know, what's the result of that on companies that the industry would have previously supported that might have been deemed a little bit more risky, the BBs?
Yeah, there've absolutely been claims in the market. I mean, the data that Richard gave you there is really telling. In 2021, there were $1 billion of claims paid out to banks just on the structured credit side, so not including short-term trade credit and public agency. It's a pretty meaningful number, and there were some concentrated claims, particularly in Asia, particularly in the commodity and trader space, which had an impact. So there were credit insurers who withdrew from this space, or withdrew from the Singapore market in particular as a result of that. I think the reality is that for some of the smaller players who don't write a huge amount of premium to be able to absorb a single large loss, it simply didn't make sense in the context of one line of business amongst many. I mean, of course, there are the monolines who are working just in this credit space, but actually we work with a very broad range of insurers who are far more concerned about a hurricane in the Gulf of Mexico in terms of their overall balance sheet position, if it were an equity event rather than just a P&L event, than they are about credit. But nevertheless, you know, any insurer loss to the market is keenly felt. And we're therefore very happy when we look to new insurers. There have been new entrants into this market steadily, you know, over recent years. So look, I think claims are part of the business. You know, if I look at my book that we run at Standard Chartered, we run as it happens, a kind of 30% loss ratio, which means insurers have made money out of doing our business. But it works for us too because of the benefit in terms of capital and returns and risk management. So look, I see some bumps in the road which have had an impact in terms of risk appetite. You're right. So insurers are now who traditionally have looked at you know, kind of sub-investment grade, sovereign risk, you know, kind of difficult parts of the world, if we could put it that way, at least in terms of ratings, have now turned increasingly to developed markets, investment grade, real estate, top-tier corporates, you know, transactions which are absolutely the staple of credit markets. You know, any banker who hears me talk about this is always astonished that, you know, real estate lending is exotic in the insurance world. Well, you know, it's not to anyone who's run a kind of Western European or US credit book. But look, diversification is clearly what insurers are looking for. I wanted to give you one example, which hopefully answers your question about, well, what can we do about this, right? Standard Chartered recently closed a transaction for a sub-Saharan African government, $1 billion deal. I think it's CCC rated, you know, really a difficult transaction to mobilize that level of private market capital. So how did we do it? Well, there were multiple tranches. There was a facility where NC, the World Bank, took a first loss exposure, and then, you know, an African development agency took a second loss, right? And then we, as the commercial banks, use the private market for a third loss tranche. So suddenly you have a way of stacking the capital layers in a way which mobilizes you know, significantly more lending capability than there would have been in the past. Alongside that were a number of ECA facilities which were supporting the export of the physical goods that were required to build the project. It was an infrastructure water development project with, you know, sort of great ESG cred. So there's a great example right there, you know, of multilaterals, ECAs development agencies, private banks, private insurers coming together in a way that supported a borrower who may otherwise have struggled, simply going to the bond market and issuing capital in a way that has been their go-to in the past. So yeah, insurers have gone up the credit curve, but there is absolutely a way for those who need financing to do this, and that's kind of why it's great to get kind of this group together, because we look at different parts of the world generally in our day jobs, but there are times when it comes together in really quite powerful and I think spectacular ways.
Thank you very much. Yeah, I think innovation in the PXF space is absolutely key, and really looking at those partnerships between international financial institutions like IFIs, multilaterals, export credit agencies, etc., is certainly the way forward versus a traditional going to the market and raising a bond. Janusz, can you delve into a little bit more into what the ECA market looks like right now, especially in light of the Russia-Ukraine conflict? And does that mean ECAs such as yours have really had to kind of step up into gear and really support more as a result of what Gary, Jérôme, and Richard alluded to?
There is definitely a trend which I think we can spot on the market, and Gary already has mentioned it, which means among ECAs and all the market players, we see the willingness of cooperation and the willingness of mitigating the risk. So everyone wants to share the risk, and that's what is really happening. During COVID times, we've seen much bigger exposure being taken on developed countries if we compare to developing countries. So developed against developing, whereas nowadays we hope the developing countries are going to pick up. And I think considering certain markets, let's put Africa, let's put Central Asia, Middle East, we see those markets coming back, which we are pretty happy about. Obviously, there is a plenty of risk, which we've been already we've already discussed it. But I think there is definitely a need of cooperation, because the world became a bit more tricky, and we see not really, especially ECAs not really being willing to acquire the whole risk on their own books, and this is something which is I think a really nice trend, and it's going to be followed for definitely a couple of years. In terms of Russia and Ukraine and Belarus, because we need to still keep in our minds that Belarus is involved as well. What we are seeing, especially from our perspective, obviously our exporters and us as such, we've lost pretty big chunk of our business. When we looked at those three markets altogether, in terms of, let's say, trade receivables, for Poland, more or less, it was a market of which was slightly bigger. There was 3 countries that were slightly bigger than the export to Italy, which I think is top 5 of our destinations. Which obviously we need to cover that type of losses, which are starting to occur. But at the same time, we need to develop more business, and I think this diversification, which has been mentioned here, is the key. So first of all, we are looking into different regions, how we can encourage our companies to go to be involved at the beginning as suppliers, then maybe as EPC contractors at some stage. But at the same time, we're looking towards especially Ukraine and trying to encourage other ECAs and companies to be involved in let's say developing the country, rebuilding it at some stage when the war is going to finish. At the same time, we're trying to support the day-to-day business of our companies. So from mid of June, we are back with trade receivables insurance. So all the transactions up to 2 years, we're supporting all the LCs. We're trying to be on the market to help to gain liquidity for the Ukrainian companies, and at the same time to help our companies to be back on those market, because it's extremely important for them.
Thank you very much, and good overview from all of you from a kind of macroeconomic and trade credit insurance perspective. Now we're going to talk about risk appetite in the context of claims. And Richard, I think you're probably best placed to answer this, but what is the general consensus on risk appetite at the moment from an ICISA perspective?
Let me start with 2 points straight off the bat. And the first is a word of caution. Risk appetite is very often seen as something which is almost binary. So either you've got appetite or you don't. What the past has shown is that is not the case. So we were approached by a treasury of a large Western European company saying, okay, how did the market perform through COVID? And what we saw is that the risk appetite did diminish, but that the dip was less than 10%. Secondly, we're in a competitive market. So there are differences between players, there are different strategies. So when I talk about the market, I'm talking about a wide average. And that's what Aon talked about in a recent research paper as well. And echoing what was just said, they said underwriters are becoming a bit more selective. They are moving up the credit curve. But there continues to be sufficient capacity in the market, although that capacity comes at a price. And that price is increasing at the moment. It is increasing in line with the increase in capital costs that we see throughout the world. And it is increasing in line with what is happening in the reinsurance market. Now, AM Best estimates that, and this is general reinsurance capacity, all lines, will decrease at renewal 2023 by some 8%, a little bit more. There is sufficient reinsurance capacity expected for 2023, but again, it'll come at a price. And what you'll see is that there will be competition between lines of business. So the credit business will have to compete with property, casualty, marine, what have you. So yes, there is sufficient. Yes, there is risk appetite, but it does come at a price.
So Gary, how do we work this out? How can the market kind of respond to some of these challenges?
You know, I started the insurance desk at Standard Chartered about 10, 12 years ago, having had a background in M&A and project finance. And I was astonished at that time. All we were doing was mining, commodities, sovereigns, right? You know, and you fast forward 10, 12 years today, and it's a much broader spectrum of business that the credit insurance market is participating in. And, you know, I'd like to take some of the credit for that, but there's plenty of other, you know, men and women doing my job at other banks who've had a role in developing the insurance market. And I think what I love about it is the strength of partnership. So what we do when we want to bring a new name, a new sector, a new country, a new product to the insurance market is we sit down together, right? And we have an education session. We bring insurers into the office. They meet the deal team. You know, we quite frequently do road shows. We take insurers out to meet our deal teams and even clients on the ground, right? You know, we used to do it in Hong Kong. We've done it in Dubai. We've done it in Oman. We've done it in a whole bunch of places around the world. It's an extremely powerful tool to be able to educate insurers who are absolutely finance professionals, but none of them claim to be experts in every single sector or geography or product or country. And therefore that partnership is incredibly important. So bringing insurers on a journey with us as the bank, who have the origination relationship with the underlying borrowers, obligors, customers, is incredibly important. And that is also demonstrated in terms of the risk sharing, right? This is not a tradable CDS market. You can't be short an insurance contract or long an insurance contract and short the underlying. These terms simply don't have any meaning in our market. This is about partnership, risk sharing, and a long-term journey, right? So I think we mentioned claims, but before you get to a claim, sometimes you get stress situations where there are restructurings, workouts, sometimes things that aren't anticipated in the documentation. But what I have found, and I think in some ways is equally important to the 100% claim payment record. We do have that, but we also have a great track record of working with insurers, to resolve stresses on a borrower. And if it comes to it, enforcing and recovering and making sure that, all right, they might have paid out a claim, but over time that is reduced with recoveries. So it's that long-term partnership that I think has been incredibly important to enabling us to do more and enabling the market to broaden its horizons and spread its wings.
Thank you very much, Gary. And I guess, being reactive to resolve some of those stresses and really looking at partnership and risk sharing is really important. Jérôme, I'm going to ask a question to you now around the role of technology and the role that a company like Tinubu can play in encouraging risk sharing, and especially with regards to different structures that perhaps didn't exist 10 years ago, and talking about some of the innovative ways that Gary looked at financing in sub-Saharan Africa. What role can Tinubu and more widely technology play in encouraging risk sharing and partnership?
I would say even more broadly, it's clear that credit insurers are going to face in the coming years a huge test for their business model. There will be winners and losers. Clearly, we are going to realize that technology can play a major role for credit insurance to ensure those market challenges. And this, I would say, in essentially 6 different dimensions. First, the first one I would say probably is the portfolio analysis, the understanding of the exposure, the consolidation of risk, the ability to report, to have adequate reporting, a good governance and transparency. Reinsurers are going to be, for example, more and more demanding for a level of information regarding the risks of the ceding company. Second, business intelligence. I give you just 2 examples. After inflow of cash in companies in the last 2 years, financial statements are less readable. Classic statistical models are less accurate. Artificial intelligence can play, and we see that already, increasing the scope of data which is utilized, an ability to better assess the obligor and to better also price the product. Second example, regarding country risk. Just give you an example. We have started to develop 2.5 years ago a model which we call the country risk tripod, which is based on open data, machine learning, and which enable to capture the dimension of the country selling and the country of export, and identifying that depending on the type of product, there is an impact of that dimension, which we call the affinity. So again, in this world where deglobalization takes place, where situations are very different from one country to another, that play a role. Third, it's clear cost efficiency. There are some players which will have already transformed their organization to be more cost efficient. Reactivity and agility will play a major role including the ability to launch, at the other point, product innovation. Technology will play a role on all those elements, as well as, you mentioned it, the ability for credit insurers to integrate themselves in a wider ecosystem, which include the ability to collaborate with ECAs for a private player or with other private players, and the ability as well to integrate with the banks and to then support the bank better and more seamlessly. There will be a pressure and the technology will demonstrate its ability to better serve at the end the policyholder and the community. That will be a key element of the response in the coming 3 years.
Thank you very much, Jérôme. I think it's fair to say on behalf of everyone, the challenging context of the macroeconomic picture right now really has forced collaboration, perspective, partnership, the development of technology, and also innovating within the trade credit insurance industry. Janusz, have we seen ECAs increasing their willingness to collaborate and share risk, and do you have any examples or case studies here?
Yes, we do. Definitely, as mentioned before, I think during the COVID time, we started to see the willingness to collaborate, and it's not only between ECAs, especially on developing markets, but it is as well between ECAs and banks, and obviously all the let's say environment which surrounds us. And I think that's what Jérôme said here, or the point that Gary touched. I think they're very crucial. Just during the COVID time, for instance, ourselves, we've changed completely our export support system. In fact, we've really twisted it, and to do so, we had to come up, obviously, with ideas, what is needed by the market, by all the players. So, in fact, we've gone to meet loads of banks, we've met loads of customers. So we've been educated, as Gary has mentioned as well, by the banks, what they will need in the nearest future. And I think that was extremely crucial for the whole project we performed. And now I'm not going to be extremely boastful about that, but I think it is one of few really flexible and interesting brand new export support system here in European Union that could be easily used to collaborate with other ECAs in order to share the risk. And I think we've already started doing it with plenty of success, especially on those African markets. We've done a couple of projects with other ECAs. And I think this is really important.
Thank you very much. So just to summarize that section really around risk in the current market, as you said, we've changed and twisted our support system, and Richard, as you said, had you put forward your predictions 2 years ago, you'd have been wildly wrong today. And Gary, you've really highlighted the nature of some of the unprecedented risks that lie ahead. I know when we were planning for this tradecast, I don't think we knew that a third of Pakistan would be flooded and underwater as it is right now. So let's try and, I'm not going to hold you to account on the invisible crystal ball I'm going to magic up, but let's take a future look on where the industry is headed in terms of outlook and innovation. Take a future look on where the industry is headed in terms of outlook and innovation. And And Gary, this sector has been traditionally very commodities focused, and you talked about, you know, the way the industry ran several years ago. There's been a shift toward managing capital and improving returns through less traditional avenues. Can you expand on this and what mediums are being used?
Yeah, I mean, I think it's quite impressive, frankly, how well the private market has embraced the opportunities beyond what has traditionally been the case. I mean, I've been one of the people banging the drum for the opportunities within the wider credit markets for insurers for many years, and we're really seeing that happen now. I guess in specific themes, project finance is a big theme. Everyone seems to want to do that together with asset-backed financing. Clearly, anything with ESG on the tin is important. It's important to do because it's the right thing to do, but it's important to do because it's going to be an ever-growing piece of what banks are doing. It's a core strategy for Standard Chartered across both the lending and the capital market structures, and I think therefore, you know, insurers are going to see increasing opportunities there. But then there are also, you know, areas of the credit markets which insurers can participate in that I don't think they've really thought about too much before. So we've placed our first insurance on acquisition finance, on repos, on capital calls, and NAV, net asset value, which is kind of sponsor financing. You know, we've looked at commodity warrants. We've done our first kind of accelerable long-term project finance, real estate. We placed a really interesting transaction, nearly $4 billion of cover, protecting ourselves against the cash deposits that we hold at central banks for regulatory and liquidity reasons in our footprint operations. And I'm currently in the market for an upsize of that. So it's a pretty exciting time to be in the markets. I think there are plenty of opportunities for insurers. I think the core purpose, you know, around facilitating trade and investment and enabling risk sharing, it should always be the guiding principle. I kind of don't want this to become a kind of speculative market. I don't think there's any danger of that happening. But within those parameters, there is still plenty of opportunity to diversify and to support the real world economy, particularly as technology moves on, right? I mean, we're looking at transactions like data warehouses, absolutely enormous, not just in the West, but in Asia and China and India too. You know, these things are kind of hybrid in terms of whether they're real estate or whether technology, but these are transactions that the insurers have already got behind in a meaningful way, and I think I expect to see that continue.
Thank you very much, Gary. And Jérôme, given this shift to look at alternative methods, how do you think the customer needs with respect to buyers of CPRI will change, and will internal organization structures need to shift to accommodate? And I'm talking, you know, the rise of big data and new technology.
First, it's clear that the customer will expect the credit insurer to be more intelligent and to participate in the development of their own intelligence. What do I mean by that? I mean that they will expect the credit insurer to understand better their business, the specificities of their business, their threat sectors, their market, their buyers, as well to take into consideration the information of their own companies. And they will need as well the credit insurer to provide them the intelligence they expect they have in a way for them to better manage their credit risks, and including potentially to provide them with the tool to better manage their credit management. The integration, they will expect the integration between themselves with their ERP, with their internal management system and their credit insurer to be better, more seamless and stronger. They will expect also the insurer to be better to integrate with the banks, with the trade platform, which are emerging. And clearly, they will expect the credit insurer to support them more strongly. They will never accept the situation to be repeated, of the past to be repeated. The level of service required will be higher in terms of responsivity, ergonomy, flexibility, and transparency. The policyholder will expect the credit insurer to be clear and transparent regarding the pricing, for example, of the product, regarding the claim, and when my claim will be indemnified, how it will be, and what the amount of the collection available, and so on. All those elements in terms of transparency of pricing, transparency of risk, availability of information will be paramount for the policyholder. So on all those elements, I think the technology can provide strong benefits, and the demand by customers will surge. That's the reason why, on top of what I mentioned regarding the ability of the credit insurer through technology to manage its own risk and to respond, that will be the second leg of what is required to run and to face the challenging environment.
Thank you very much. And I guess one final question to Richard now. I'm afraid we're almost out of time on tradecast, but Richard, how do you see the capacity of risk evolving, or perhaps devolving, and where do you see this taking the market?
One of the reasons I'm incredibly proud to be a part of the credit and surety industry is its resilience. So if you look back at the past economic downturns, the shocks that the economy has sustained, the one thing was constant, and that was the will and the ability of the industry to support risk and to support its clients. I expect that firmly to continue into the future. All the economic shocks, all the downturns were slightly different. This one is different again. What will not change is its resilience and the capacity.
Thank you very much, Richard. And I'm afraid I'm calling time on this very insightful, important tradecast. The news of a V-shaped economic recovery with nearly 97% of claims paid. You'd think it was quite a pretty picture for trade credit insurance. Certainly an umbrella that's ready to open during the storms. But I think the picture is certainly nuanced, and tough roads lie ahead. Obligors continue to drive innovation and partnership in the CPRI space, whether it's through multi-tranche, multi-party transactions in project finance, or perhaps through using AI and big data to better assess risk. What's sure is the CPRI market is operating in a totally different space to where it was a decade ago. Once again, I'd like to thank Tinubu, our sponsors, for this tradecast, and the recording of this tradecast will, of course, be available to download alongside with a series of write-ups from the fantastic TFG team. Thank you finally to our excellent speakers for such a well-rounded, thought-provoking tradecast, and credit where credit's due to Gary Lowe, Jérôme Pezé, Janusz Władyczak, and Richard Wolff. I'm Dipesh Patel. It's been a pleasure to be your host today. Goodbye and good night.
Thank you.